SEBI has introduced significant changes to the F&O market. These new rules set to take effect from November 2024 and aim to promote market stability, curb excessive speculation, and improve risk management. Today we are going to have a deep dive into these new rules and review how it is going to impact you as a small investor. Hello everyone, welcome back to Nandu's Equity. The first and foremost thing which is a notable change that is going to be implemented is the contract size for index derivatives. Effective from November 20, the contract size will increase from 5 to 10 lakhs to 15 to 20 lakhs. This move raises the entry barrier for small investors, making F&O trading more capital intensive. SEBI's goal is to deter speculative trading and encourage a more disciplined market environment where participants with sufficient capital can engage in trading. For example, if you have your total capital between 5 lakh to 10 lakh, I do not think that is going to be a good news for you, because it's going to be very difficult as they are going to increase it to 15 to 20 lakh contract size. Second thing is SEBI has decided to reduce the number of weekly index derivative products. So exchanges like NSE and BSE will now be limited to offering weekly derivatives contracts only for one benchmark index. This move aims to curb excessive speculation tied to short-term market fluctuations, thereby fostering a more stable and orderly market. The reduction in weekly expiration will encourage traders to adopt longer-term strategies rather than focusing on quick and high-frequency trade. Upfront collection of option premium may be shocking to you. Starting from February 1, 2025, brokers will be required to collect the full option premium upfront from buyers. In the current setup, traders can purchase options using leverage, meaning they pay only a fraction of the premium. This practice has led to increased speculative trading, with many traders entering positions which they cannot even fully back with capital. The new rule ensures that only those who can afford to pay the full premium can participate, promoting more responsible trading behavior. The fourth important change is increased margin requirements for expiry days. On option expiry days, SEBI will introduce an additional margin requirement known as the extreme loss margin, effective from November 20th. Option sellers will face a 2% increase in margin requirements on these days to protect against the extreme volatility often seen during expiration. This additional margin provides a buffer against sharp price swings and reduce the likelihood of massive losses during the volatile trading hours leading up to the close of contracts. Another key changes involving SEBI's monitoring of position limits. From April 1, 2025, brokers' positions will be checked at random intervals throughout the day, as opposed to just once at the end of the trading. This will ensure that no single participant holds an excessively large position in index derivatives at any point in time. The introduction of intraday monitoring could introduce more uncertainty for traders who may need to adjust their strategies frequently to remain within allowable limits. Starting from February 1, 2025, SEBI will eliminate the margin benefit previously available for calendar spreads on expiry days. This is kind of a typical adjustment many traders do, like calendar spread involving holding of long and short-term positions in contracts with different expiration dates, and traders historically enjoyed a reduction in margin requirements for such positions. Under the new rules, this benefit will no longer apply, meaning traders will need to maintain higher margins for calendar spreads, making this strategy less attractive on expiry days. On retail investors like you and me, the biggest thing is higher capital requirements. That's an immediate impact for all of us, as we need to increase our retail capital significantly for F&O trading. The problem is, with the increased contract sizes and upfront premium collection, the cost of entering positions either side will rise sharply. The smaller traders who previously relied on leverage and lower capital to participate may find themselves priced out of the market, which could lead to a shift in market dynamics where institutional players dominate. The reduction in the number of weekly expiries will limit opportunities for traders who focus on short-term strategies. These traders who engage in high-frequency trading based on weekly expirations will need to adjust their approaches. With fewer short-term products available, they may either transition to long-term positions or explore other markets to maintain their trading volume. The introduction of intraday monitoring will add a layer of complexity for traders. Since positions will now be checked multiple times a day at random intervals, traders may need to continuously monitor their exposure to ensure they do not exceed their position limits. In turn, this could lead to more dynamic trading strategies and potentially higher operational costs for both traders and brokers, who must now implement systems capable of real-time position tracking. Brokers will also feel the impact of SEBI's new rules. With the requirement to collect full option premium upfront and increase margin requirements on expiry days, brokers will need to ensure their clients have enough capital to meet these obligations. Additionally, the need for real-time monitoring of position limits will require significant investment in technology and resources, adding to their operational and compliance costs. Some brokers may lose retail clients due to the increased capital requirements and reduced trading opportunities. Retail investors who have historically relied on leverage and frequent trading opportunities through weekly expirations may choose to exit the market or switch to less restrictive markets. This could lead to a decline in number of trades executed and consequently a drop in brokerage revenues from commissions. The reduction in trading activity due to fewer weekly expiry products and higher contract sizes could negatively impact brokers' revenues. Brokers earn commissions based on the number of trades executed, and with fewer traders participating and lower trading volumes, their income could decline. To offset this, brokers may need to focus on offering value-added services such as research and advisory, which is already there, to attract and retain high net worth individuals and institutional investors. So there is no way they can really retain some of the small investors because of so many different challenges as the capital intensity is going to increase. While the short-term impact of these regulations may be challenging for some market participants, SEBI's goal is to promote long-term market stability. By discouraging speculative trading and encouraging higher capital requirements, the market could see reduced volatility and more sustainable growth. The focus on long-term strategies over short-term speculation may lead to a healthier derivatives market overall. Both the traders and brokers will need to adapt their strategies and operations to the new regulatory environment. For traders, this means focusing more on long-term positions and ensuring they have the necessary capital to participate. Brokers, on the other hand, will need to upgrade their compliance systems and offer enhanced services to cater to a more sophisticated client base. Flexibility, adaptability, and a deep understanding of these new rules will be essential for success, and I'm sure this is going to take a little longer time for many retail investors to completely understand them. In conclusion, SEBI's new FandOTrading rules mark a significant shift in the Indian derivatives market. While the changes present challenges, especially for retail traders and brokers, they also offer an opportunity for more stable and responsible market. As the implementation dates approach, traders and brokers must stay informed and prepare for the adjustments necessary to thrive in this evolving landscape. Ultimately, the long-term benefits of reduced speculation, enhanced risk management, and market stability will outweigh the short-term disruptions caused by these reforms. However, there is a significant impact to the retail investors who may not really like, as the participation itself will become a question mark for many of them. Thank you for watching. Please click the like button if you find this video to be useful to you. Please subscribe if you have not subscribed. Share this video with your friends and relatives, and also share your feedback in the comment section.